Thanks for tuning in to BQ Conversations. Now, everybody seems to be obsessed about the rural recovery, maybe because of the inflation print, maybe because of conversations that happen on media. The question is this for real, and do the benefits, if any, come with some bit of immediacy, or do they come with a bit of a lag? And is it even possible to predict that, or are there too many uncertainties surrounded? Well, we thought it's best to pose these questions to somebody who's entrenched within the rural economy, not just for his company, but because of his wealth of experience, can probably talk about how would it matter for the economy at large. Mr. Ramesh, Iyer of Mahindra and Mahindra Financial Services joins us on the show. Ramesh, so good having you. Thanks much for taking the time out. As much as I would love to understand from M&M Financial's perspective, first, just your thoughts. You would have read so many headlines on the websites, on television as well, about the rural recovery slated to happen anytime soon. What are your thoughts on this?
So this is what we see on the ground. Yes, I think last 1 year wasn't very, very easy. All of us know the growth has been stunted. But nevertheless, I think the cash flows in the hands of the consumers is what we feel has been positive. But I've always said this, rural depends on two cash flows. One is the farm cash flow, and the other is the infra cash flow. Right, which means a lot of infra activity needs to happen. People deploy their assets, labor get deployed, the money comes in, consumption begins to happen. Surely on the farm side, yes, we had this extended monsoon, but I think after the yields were out, the prices were good. I think there is this kind of happiness in some states where they are getting good cash flow. We do believe that going forward, the farm cash flows are expected to be good. So that's driving the sentiment a little positive, surely. What's it waiting for, I think, is the infra to open up. In some of the states, we do see some activity. But if it opens up across, I think then you will see a real boom in the rural.
Okay. So, would it be safe to say that while there are green shoots, it is still unpredictable at the very least?
I would think so, and maybe instead of unpredictable, I would still think the consumers are waiting to see more action. Right, so like, one example possibly may explain this little better. We've always seen in the rural in the past is, when the business is good, the recovery collections are good. But in this round, we saw last couple of quarters where the business growth has not been very, very aggressive, but definitely the recoveries have maintained well all through the year, which means that consumers have money and they are possibly putting it to discharge a liability rather than acquire an asset. Which is an indication of they're waiting for something else for the consumers to start buying assets. It could also be for reasons that, this change of emission norms coming in and people are not sure whether it's good to buy BS4 or wait and buy BS6. All of that could also be possible. But nevertheless, clearly we don't see an aggression to acquire assets as though there's a lot of business waiting to happen and therefore, I need to add asset is not the rush that we are seeing. So that's waiting for something to happen.
Could it also be because corporate India is deleveraging, so people are learning from the larger peers? Almost all of corporate India is not setting up capex. Corporate tax cuts happen, and yet we don't see the first evident signs of large capex happening from corporate India too. So there's a deleveraging going across.
But that could be possible if you were to talk about large fleet operators and all that. I mean, if you talk of individual consumers who acquire asset for a daily use, they seem to be using their current asset which they own for a little longer than they would have normally used. If somebody wanted to change an asset at the end of third year, possibly is trying to use it for one more year, saying, why I buy something new so fast. And it also could be for a reason that I think most of the time we've seen in this kind of retail assets, the resale price decides the exchange program. And with discounts on the new vehicles being so aggressive, possibly the resale price is also hit to an extent. So people are probably waiting to say if BS6 comes in, will BS4 demand go up substantially? Because the price of the vehicle could be so different and the earnings therefore could matter the most. It could be one of the reasons as well.
Does this happen often? The reason I ask this to you is because I know, from past experience, we've traveled once together as well in the hinterland, that you do a lot of dipstick study and try and get information firsthand from people yourself too. What is your sense? Does this happen too often? And if not, could it be only these factors, or could it be that the guy who's on the ground is still not completely decided? Forget infra, about the farm income as well. There is talks of Rabi season looking strong, but maybe the confidence is not there.
So I think, when the previous monsoon and it got overextended, there was this fear. as to what would happen next. But then with the water levels being good, right, all across, I think the sowing is definitely going to be good and all that. So I think some sentiments are returning back to positive, imagining that the farm next round will definitely be good. We did see some improvement in numbers as well in tractors and other products. So I would think you're right, people are still undecided on, should I kind of rush into buying some asset? And I think it's also by state. It's not appropriate to kind of sum it up on an all India basis. Right, so different pockets have shown different signs, like MP has been very buoyant, Rajasthan has been buoyant, right, UP has been buoyant, Bihar has been okay, Gujarat has been okay, Maharashtra is not yet but possibly will start picking up. The southern states have gone a little slow. So it's also important to understand that it's not a phenomena standard across the country. Different states have shown different behavior patterns.
Okay. The one print that enthuses most people into believing that the farm income will go up is the food inflation print, which is certainly moving up. What's your sense? I mean, because you would have seen such things happening in the past as well. Do you reckon that the next 6 months, the probability of rural farmer income moving up is substantially higher?
I think that's a true story, right? I mean, if the prices were to go up, the farmers do benefit definitely. And that's the time you will start seeing them once again acquire asset, or you will start seeing them doing up their houses. We see this many times in our rural housing business, for example.
Yeah.
Right? Whenever they get some extra income, I think the first thing that they try and do is to do up their house. Right? Because they don't really want to borrow for a room addition or a room expansion, while we have that program out there. But we don't see too many of them rushing to do that. They think that if my income flow is better, I would rather use my surplus for that purpose. Right, and that kind of a thing can be seen in the next couple of months before the next monsoon. I think we would see that kind of a consumption happening. And we do believe that the prices going up will leave more cash in the hands of the farmers, which would then be put to consumption.
But you're not seeing signs or talks of that right now, or initial signs are being seen?
I would think we are seeing it, and that's the reason I use the term, our recoveries are much better. Right? So I think there are people who have discharging liability, and we have met consumers who have not been able to pay in the last round, and their billed overdues are clearing it. So therefore there is this money, there is a clear witness of there is a flow of income that's happening. I think the real question is, what are they putting that money to use? Are they acquiring asset, or are they discharging liability? And I see in some pockets they are discharging liability. In some pockets we do see they are acquiring assets.
Yeah, I think in an earlier call, maybe at the end of Q2, as I noted from a brokerage note, that you had mentioned that you believe that there will be a round of deleveraging as opposed to people acquiring assets meaningfully. You reckon that will still continue?
Yes, and I think we saw it in the third quarter. And I would believe that it will continue until the next season.
Until the next season.
Which would mean, my own belief is that you will see a lot of things changing to better by the next festival season. You will see people start buying assets, because then the second crop would be known, the monsoon directions would be known. So I think you will see the return of sentiments. I'm talking more from the rural perspective.
Sure.
Clearly the next September, October, you will start seeing things to look much, much better.
Would there be telltale signs which will indicate that in the run-up to the monsoons, or would we wait for the event to happen?
No, I think if you see the January-March quarter, how the crop turns out to be, the Rabi come out is, and then initial announcement of how the monsoon is likely to be is good enough.
Okay.
We won't wait for the whole monsoon season to be over.
Okay. Just one. Okay, since we dwelt upon M&M Financial a little bit, I would want to talk about that a bit, and then I would want your views on what the RBI did, because a lot of people are saying that Das has done a Draghi. Your thoughts, and whether there are some things that keep you awake at night when you look at the landscape. But first, M&M Financial, since we spoke about all of these things happening, they probably fit right into a sweet spot that your company could be in. There's a note which wrote that there's a correlation coefficient, according to them, of a negative 0.65 between food inflation and your GNPA cycle. Indicates that when food inflation increases, your GNPAs come down, but it happens with a bit of a lag. Would you second that? They have looked at some past history and come at this conclusion.
I think it's clear, right? I mean, we work with a lot of these consumers whose one important cash flow comes from the farm cash flow. And therefore, if they are going to get a better price for their output and they're going to be left with more money in hand, I think they will use it to discharge their liability. One great news about the rural market is there is a definite de-link between what is an NPA and what is a bad debt. Right? What becomes an NPA does not become a bad debt in rural. It's just the delay. right? So it's a regulatory need that you make an NPA provision when it hits a 90-day kind of a cycle. And these kind of consumers are likely to hit these cycles more often when things delay. But we have seen almost all time in the past that we don't lose money.
You said this in the past to us.
Yes,
as well,
and when we very strongly believe it's a collateral backed lending where the consumer invests 25% of his money to acquire that asset and he puts it to a productive use. So very clearly when the kind of cash flow improves due to either the food inflation improvement and therefore the money comes in or whatever, we do see that they discharge liability. And which is why you see the correlation that when such an event happens, the NPA for us comes down. And even during the year, you can see there is a distinct difference between first half and the second half, because the cash flow in the second half is almost good to harvest and festival and all kinds of activity around, and they do discharge the liability of what they have not paid even in the first half. So I do subscribe to this thought and view that yes, it would happen.
Okay, so and since you spoke about how there has been deleveraging already on, would you reckon that that process for you as a company is already started and it only accelerate into Q4 and the first quarter of the next year onwards?
I would think so. I mean, never before we've seen in the past. I mean, I've been running this business for 25 years now, and I've not seen it so much like in the past, where in the first and second quarter, you see NPA stabilizing or coming down. In this year, we saw that. So if I was to look at number of consumers who are in my delinquent account, they are almost similar to what was 1 year back. But invariably what happens is when you finish your 31st March book, after all the recoveries that happen in the second quarter, you start to move up the NPA in the first quarter and second quarter when there are not too much activity. But in this round, we didn't see that happen. So that's a very clear correlation of people are discharging liability out of the surplus that's there in their hands. And if that trend was to continue, I think, which we believe it will show this improvement in the asset quality for us, which we have witnessed in the first 3 quarters.
So would that embolden you, Ramesh, or would you, because of the way things are around, by nature stay a bit cautious? I was just some data as I look at December 2019 versus September 2018, the one space wherein your lending seems to have come off quite a bit is SMEs and others, right? From 14% you're now at 7%, which is a conscious call I presume you have taken.
Yes.
Do these events, deleveraging, NPAs not moving up, embolden you or still keep you cautious?
So let's look at lending into 2 buckets. One, what's our ability? Do we have enough liquidity? Do we have enough reach, right? And do we have the process in place to be able to lend? That's always been the case and we are well ready for that. At the end of the day, not to forget that we are only an enabler. I don't want to be seen as someone who's saying that I give you the money, why don't you buy an asset? I want to always be seen as someone who says that, you are interested to buy an asset, we are there to enable you buy that asset, right? And therefore, if we play that enabler's role, unless the prime selling picks up, there's no way we can influence that sale big time. Now, where else can we therefore afford to do that? Will be a pre-owned vehicle segment, right? Where the demand for the vehicle would be there because they are at low price and meets the same purpose. And therefore, if you look at our pre-owned vehicle growth, that has substantially grown. That's growing at 30% plus. Now, we are not in pre-owned commercial vehicle, but we are in pre-owned utility vehicle, cars, tractors, and all of that. And that's going to be a segment that we are concentrating well. So I would think our growth would come from there. Clearly, we are gaining market share in new products as well because we don't see too much of competition yet out there. And that would help us grow to some extent. But as otherwise, in terms of volume terms, unless the OEM growth picks up, there's very little that we can do to register growth.
Okay. Actually, just a follow-up there. I think we did a story, if I'm not wrong, on the preference for the pre-owned versus the fresh ones. And clearly, say for October, the vehicle sales numbers haven't been the most impressive on the first-hand side. Is the second-hand market slightly different or dramatically different?
So I think there is a need for a vehicle. The affordability does not allow them to buy a new vehicle at that price. And therefore, you do see many buyers willing to look at a pre-owned vehicle, right? Now, pre-owned vehicle has a very typical approach. One, when the new vehicle discounts are high, the pre-owned vehicle prices drop, right? But because there's so much of need and demand, the supply side has become weak and they have been able to hold on to the price. That we are witnessing very clearly even in our repossessed vehicle, right? If somebody surrenders or we repossess a vehicle, the demand for that is very, very fast. And we don't see there to be sold at a throwaway price. right? So I think that space is becoming attractive, but for sure it's a space which requires a very different skill set as compared to the skill required to do a new vehicle financing. In the new vehicle financing, you don't much worry about the product, you much worry about the consumer's capability. But when it comes to a pre-owned vehicle, you also need to worry about the product as to how do you inspect them, how do you price them, because you don't have a blue book equivalent where you can bet on the price automatically. Different vehicles of the same mileage used for the same purpose can command a different price, right? So therefore, ability to inspect and understand pricing of a vehicle becomes extremely essential. Right? If somebody who's built that skill can play this game extremely well.
Okay, so let me try and ask this to you. You would have some contraction in your first-hand vehicle loan book, 2 wheelers, 4 wheelers, what have you, but the pre-owned or the second-hand, loosely put, is probably doing well, and you have asset quality pressures not being seen. What does this mean for both the disbursement growth and the asset quality for the next 3 or 4 quarters? Is it possible to think that far out in the current scenario?
I think the answer is yes. For sure, for any NBFC, while growth is essential and important, I think the success of an NBFC largely is measured by how well you recover, how good is your asset quality, right? So I think, as I mentioned, we do see traction out there. Consumers are willing to discharge liability. They are coming for settlement. All of this is witnessed for sure. So far as the growth is concerned, you're right. The new vehicle sales will decide how much will an NBFC grow. Yes, this room to gain market share is there, but not substantial. You can't offset the volume by a market share gain because you're not the only player out there, right? We do gain little market share, and our penetration strategy has worked well for us to be able to generate self-sales, and therefore that becomes an added volume. So I would think that the new vehicle sales will show growth as against the industry degrowing, but that's not substantial enough. So the pre-owned vehicle comes and plays a good role. Now, pre-owned vehicle, in our case, we have 2 or 3 approaches. One is our own consumer trying to sell his vehicle to someone else becomes one of the possibility. Second is we do work with all this OEM-based aggregators like a True Value, etc. And therefore, there is that possibility surely. The third is, in the market that we operate in, there are local aggregators who do buy these vehicles and look for consumers who want to buy a pre-owned vehicle. So the 3 together, definitely we have an aggressive growth plan out there. But I must tell you that the price of a pre-owned vehicle is 50% or maybe 40% of the new vehicle price. So therefore, the volumes have to be substantially large if you're looking at offsetting something. So if a new vehicle business normally would grown at 15-20%, it's impossible to imagine that pre-owned vehicle will be a substitute. But yes, from a degrowth situation, it allows you a growth story. So if we were to look at a 3-5% growth from new vehicle, to push you to a 10% pre-owned can support. But if you have to really get back to a 15-20% growth story again, then the basic numbers of the new vehicles will have to go up.
Okay, and you saying that, I think the reference that you made to the asset quality as well, just look at the hard numbers. For 9-month FY20, the gross NPAs have inched up compared to end of FY19. Is this again a belief that while this is a reported NPA, it will not be eventually bad debt?
Oh, surely it would not be. Money won't be lost. But it's also important to understand that we have done business for 1 year during the same period. Right? And those will also have some NPA coming in.
Got it.
Right? And therefore, you will always see those percentages. So sometimes it's an effect of the denominator. Right? Okay. If the asset was to grow at 15-20%, the same number would have looked 2% lower. Right? So the assets aren't growing. And therefore, within the available asset book, there will be some NPAs which come in. But I must tell you that if we have 1,25,000 or 1,30,000 account in NPA out of our 3 million live cases, right? And we will see 50-60% of them even today are repaying. It's just that they can't pay you for what has been built as an overdue. And therefore, they continue to remain in an NPA. Then when the cash flow starts to improve, then they come and discharge their liability. Which is why you will always see our year-end numbers are almost half of what we see during the year.
You mentioned this at the start. Yes. So you would reckon that these numbers also will improve as you end the year?
Of course, yes.
Okay. And one more follow-up to this, Ramesh, would be that for a company like you, is getting the money at the rate and the cost an issue at all? Or do you reckon that the larger issue is that there is demand which is not there, and therefore disbursements will not grow because of lack of credit availability at the rate that you want, but lack of credit disbursement opportunities at the rate that you want.
So I think it's very clear, right? Even 1 year back when there was so much discussion about liquidity pressure and all that, I think to us to get money wasn't difficult, price was different. As we speak today, both getting it and getting it at an attractive price is not a challenge.
Not a challenge.
Not a challenge. So it's clearly, therefore, is there so much demand for the money, right? And as I said, we are not going to chase growth just because we have money in hand. Ultimately, the consumer will have to express desire that they want to acquire an asset for a purpose, and then we will enable them to buy that. So clearly, in our case, the growth limitations come from demand and not from liquidity side.
So you don't feel the itch or the need to try and diversify into slightly outside from your core segment, which because of various reasons might have issues. There is no demand for autos, for example, but there is a demand for consumer durables. There is a demand for personal loans in a big way. Surely getting into the market should not be as difficult for you, even though it might be difficult for a new entrant per se.
So let's first get this right. Strategically, we want to continue to be a very strong semi-urban rural player.
Okay.
So that's the geography boundary that we put for ourselves. Second is, we don't want to be not seen and recognized as a very strong auto tractor player.
Okay.
That's our core, right? That's our balance sheet. Third is, we will not therefore shift geography because temporarily where we are is creating a little pressure for us. Right? We have seen it in the past. You need to have the patience, stay put there and whatever. The fourth is, any product that we get into should have an ability to substantially contribute to your balance sheet, as otherwise the resource that you allocate are disproportionately larger for the returns that you make, and they don't have an ability to offset what we do. Now therefore, the fundamental question we have to ask is, just because something that you're so good at is not doing well in the marketplace currently, should you really relook at a new strategy? Let's say the answer is yes, why not? Then we would rather look at a company if it's available to be bought, and if that's our future strategy, or buy assets, buy a portfolio and try and see how to handle it, and then try and see a way to grow it. But just to start all by ourselves, right, at this stage when things aren't so well out there, you can't ramp up that business overnight. You need to resource people, you need to skill them correctly, you need to kind of ensure your branches are able to service those consumers and etc. etc. So by the time we get ready to do all of that, the auto market may pick up again. Right? So we will be cautious in trying to do that. We have looked at certain products and we have felt that those are not the ones that we need to chase.
Now, I was just wondering if indeed there are cross-sell opportunities into pockets which you may not have considered. I'm not really talking about
I'm with you.
Realigning your business model completely.
I completely with you. If my existing 3-4 million consumers that we have worked with, if they require any of this product, I think we are doing that.
Okay,
but they won't speak big in our overall balance sheet, right? I mean, if we have a 70,000 crore balance sheet, even if all of this adds up to 1,000 or 2,000 crore, it may look to be a small number there.
Okay. Now, we're an industry at Ramesh. M&M Financial is doing what it is doing, which is fine. I mean, we've spoken about the quarterly numbers, so I won't get into all of that. 12 months out, do you see probabilities of a credit risk wave number 3 or number 4? You can number them whichever you want because different people number them differently. Do you see a probability of an issue which could hamper the system coming up? Or do you think there are enough checks and balances now to thwart any repeat of an IL&FS kind of a scenario? Not necessarily a repeat of that was very big, but even kind of that happening.
I think we've seen cycles come in and go. Any NBFC which has been in business for long and stick to his focus may not show up that kind of a challenge.
Yeah.
Right. If someone who's kind of looked at chasing certain assets because some of the assets that you were in were not working well, and you have not built that ability to handle, can suddenly bunch up to come out to be a new credit problem. Right. I somehow think in personal loan segment one could possibly see something of that type. May not be of a large size and magnitude, but surely asset quality issues could possibly be out there, because the borrowers of those loans are at the end of the day salaried individuals or people who have certain aspirations to be met, but currently their revenue don't support that. And unless the cycle starts changing and their earnings starts to improve, right, sometimes they can hit that roadblock, and that could turn out to be some kind of a, an NPA from that segment. So clearly unsecured loan segment where, at the end of the day, lending needs to have some interaction with consumer, right? You must use technology appropriately. You should control it through technology, decide using technology. But at the end of the day, when recovery starts to, get a little difficult, then you must know whom have you lent to and where are they. And that unsecured loan segment possibly could be having some pressure if earnings of individuals were not to catch up.
Okay, difficult to preempt, but likely to happen as well if indeed things don't work out. The other thing is, sometime around March 2019, almost everybody was the opinion that the large NBFC will gain at the expense of the NBFCs in trouble. So a select few, 8-10 companies will disproportionately grow. As the numbers have shown, while none of those large NBFCs have had major issues, but they haven't really put the foot on the pedal in a way which would show a then and now. Now my question is, you can't speak for everybody, but I'm still just trying to ask you to crystal gaze a bit. Would this be a factor of also the slowing demand and therefore not wanting to go full throttle at a time when the economy is slowing? And therefore, could it change? Would you, for example, if the asset qualities were not an issue, looking at the ecosystem and the things right now, be able to grow at a much faster clip than what you're growing right now?
I think, as I said, for growth you need two things. One is your readiness and liquidity availability. I think that's all ready. We are all waiting to see, okay, how do we put that to use? We are well capitalized, so that's not an issue. But the asset side has to support the consumer demand, has to start going up. If the consumer demand had to go up, then you will see what you mentioned, that the large ones are growing at a much faster pace than the smaller ones. I think to the credit of the smaller ones in this round, I think they have also focused on their asset quality rather than chasing growth, and therefore you're not seeing too many of them getting out of the business or the big ones trying to buy them out or whatever. But if the growth had to return back, and raising capital and debt is not going to be very easy for everybody, having seen what everyone has gone through. So therefore that's a time possibly one would see that the big ones are in a better position to raise capital as well as debt from the market, and they would possibly register much faster growth.
You might see, you reckon you could see a round of consolidation as well?
I would think so. I would think so. I mean, the smaller ones themselves will ask a question that if the growth is not so easy, recovery efforts have to be substantially higher, is there a good sense to become an extended arm of a larger one? Right. Now, whether it's consolidation or partnership or large one investing in a smaller one to help them go deeper. So various formats could emerge. But yes, if you were to put them under the larger heading of consolidation, you will see some of the format changes.
Okay, one last question, and that's on the policy. A lot of people have, opinions have differed, but a lot of people by and large have lauded a few decisions that have been taken in the policy. What stood out for you? What do you think could have been done, may have been missed due to various reasons, but was not done?
I think for us, we believe that it's a good policy from the point of view that directionally, it does very clearly show that the interest rates regime is on the decline. And for an NBFC, what else could be better? I think the other is making the liquidity available in the system. All said and done, today the demand could be weak. But unless the overall system is ready with liquidity adequate, I would think that to even think of demand could become difficult. Right. And I think with the BS6 coming in and all that, I think those products would need a lot of support. And I think in both of this front, both in terms of availability of funds and focusing more on which segment would be provided that kind of a support, along with the very clear direction of how the interest rates are likely to start settling down and go down, I think we are very, very happy that the direction is that.
Okay, well, let's hope things improve sooner rather than later. But yes. Ramesh, Iyer, take a moment to thank you for joining in today on BQ Conversations and giving us your thoughts. A pleasure having you.
Thank you.